As a day trader, one of the things you like to keep an eye on are the largest gainers of the day. Now, it's not uncommon to find a stock that's gone up 50%, 100%. Sometimes you even find stocks that have gone up 1,000%. Why would a stock make such a large move? Some of these can be eliminated fairly quickly. They could have a stock split, or it could be a buyout or a merger or acquisition. But other stocks, they make these large moves off of some type of catalyst, which could have been a press release for good news, or could be a chat room buy, or a mention on CNBC. But this still doesn't explain why some stocks make such huge moves while other stocks, they receive good news and hardly move at all. Now, one thing that most new traders overlook, and something that's critical for day traders to understand, and that's the stock's float. And many of these stocks that make large moves have a very small float, and they're often referred to as a low float stock. Hey, this is Dan with daytrading.buzz, and today we're going to discuss low float stocks. I'll go over what a stock float is, where you can find it, why is it important to you as a day trader, what to look for and what to avoid. So what is the float? The float is the total number of available shares to trade in the open market. To calculate the float, you first have to start with the number of outstanding shares and subtract out the number of restricted shares. The restricted shares are the shares owned by the CEO or the employees or owner or other insiders. Once you subtract out the restricted shares from the outstanding shares, you then have the float. But fret not, you will not have to perform this mathematical equation, since the float is easily found through sites like Yahoo or FinViz, or you can often locate it right from your trading platform. Now, I will go over a few examples on how you can locate a stock's float, and I highly recommend that you check the float in multiple locations if you plan to trade. What I have discovered is that the float is not always reported the same through the different resources. And for my own personal trading, I will use the higher of the listed floats if I find a discrepancy. This doesn't mean that the higher listed float is more accurate, but I would rather err on the side of being too high than being too low. Let's go over a few examples right now. If you go to Yahoo Finance and then enter a ticker symbol, along the left-hand side of the page, you will see multiple links to different information on that stock symbol. If you scroll down under Company and you click on Key Statistics, and then go over to the right side of the page and go under Share Statistics, here you will see the whole breakdown of the shares, and you will see the float listed. For this particular stock, the float is 20 million. For a second example, we will go to FinViz. Just enter the ticker symbol on the top left-hand side of the page. Go down underneath the chart and you will see a list of all the stock information. And here you will find the stock's listed float. Just like on Yahoo Finance, the float was listed at 20 million. So I'm sure you're wondering, what is the significance of the float? It really comes down to the basics of supply and demand. In the world of trading, there are a finite number of retail traders. Out of the pool of retail traders, these traders are trading a large number of different stocks, leaving an even smaller number of traders available to trade any one particular stock. If you take, for an example, a stock like Microsoft, which has a float of over 7 billion, if Microsoft releases a press release with some fairly good news, and the portion of retail traders that trade off this news make up, say, 10 million shares of trading volume. This 10 million shares of trading volume is going to be insignificant to the overall flow of 7 billion. If these same retail traders were to all jump onto a stock with a float of 5 million, this demand will have an enormous impact on the supply, causing the price to go up, sometimes dramatically. Here is a simplified version to show how a low float stock moves. The yellow squares represent the shares that make up the float. These could be 9 million shares, with each square representing 1 million, or it could be 9 billion shares, with each square representing 1 billion. It's just a matter of scale. But for the purpose of this video, we'll just keep it simple and look at them as individual units. And the people inside each square represent the current holder of that unit of shares. When one of these shareholders would like to sell their shares at the current market price, a dollar sign will show up within their box. The people underneath the dollar bill represent the buyers, the traders that are in line to buy at the current market value. And to keep it simple, each buyer is looking to buy one unit. Currently we have one buyer and one seller. The buyer purchases the shares from the seller at the current market value, and there is no change in price. This buyer now becomes the current shareholder. If the company was to release a press release on very good news, or perhaps the stock receives some other strong catalyst, additional buyers will come in and buy up all the shares at the current market price, causing the price of the stock to go up. At the higher values, there will be additional shareholders willing to sell their shares. With a low float stock, it's common to see a large surge in buyers that exceed the sellers, often causing a price to rapidly increase. But with a low float stock, if the news is large enough, there's often buyers who are willing to chase the price up. As long as the buyers continue to exceed the number of sellers at each price range, the price will continue to go up. Eventually, the buyers will start to dry up as the price continues to get higher. This will cause a reversal and the price will drop. What is common with many of these low float stocks that move up on a catalyst, the move is an overreaction and the price goes up too high too fast. Once the volume dries up, you'll often see these type of stocks fall almost as quickly as they rise, which can provide some fantastic shorting opportunities. But similar to how risky these type of trades can be for a long biased trader, they can also be extremely risky for a short biased trader. While it may experience a large pullback after a significant move, that doesn't necessarily mean the trend has changed. It is extremely important to pay attention to the trading volume when these low float stocks move. Volume often has the greatest impact on what the stock will do next. And as is often the case, the price could pull back off its highs and then consolidate throughout the day. But if the news is good enough, or the catalyst is strong enough, or a stock is receiving enough attention where the trading volume is large enough to exceed the float, it is not uncommon to see a much larger move after this consolidation period. This is why it's important to pay attention to how the stock reacts on a pullback. If all pullback are getting supported without any major selling and pushing the price up higher, you'll often see a continuation. Where this can really become interesting is when a large number of shorts get into one of these too early on the move up and become too biased or too stubborn to cover their shorts. While their reasoning behind shorting the stock is often fundamentally justified, shorting too early can be devastating to their account and actually contribute to the larger move up. The important thing to remember with these low floats is if the entire float is getting turned over, the fundamentals of the company and the fact that the stock is up considerably no longer have as large of an impact on the short-term movement of the stock. If volume continues to hold up, then these stocks start to take on a life of their own. Let's go back to the example. After each consolidation period, with a low float stock that has already traded the entire float, a large majority of the shareholders had just recently purchased the stock at this higher level. And while there are still some shareholders that have bought earlier, they've had this entire price range to sell their shares if they wanted to. On top of these current shareholders, now you have shorts who know the stock has already gone up way too much. But unlike a stock with a much larger float, which would have many shareholders who have been holding since a lower price, willing to sell on one of these big moves, with a low float turning over the entire float multiple times, there are less shareholders who have owned at a lower price who are willing to sell. And without many sellers, the buyers start pushing up the price again. Once it reaches a new breakout level, you then have a rush of breakout buyers buying into the breakout along with shorts attempting to cover into these breakouts. And this whole process can reset itself again with the price making another major push north and then pulling back and consolidating. And as long as the volume keeps up, this process can occur over and over. Now, it'll eventually come to an end, but predicting the top is not always as easy as you would like to believe. And now let's go over some recent low float runners. BSPM recently made a big move off a catalyst. The float is listed at 1.77 million by Yahoo. You can see on June 6th, the entire trading volume was 10.8 million, or more than 6 times the float. The price on the first day ran from the low 130s to a high of almost $6 in one day. But as you can see, the following day, the volume was reduced down to 2.04 million. Another example of a very large runner recently was HMNY. Yahoo has the float listed at only 319,000 shares. On June 6th, the company released news, and the original trading volume kind of started off a little slow, but as the day progressed, the volume picked up. The first day, the total trading volume was over 9 million. This is off a stock with only 319,000 shares in the float, traded 9 million shares. So the float was churned over multiple times. But the run didn't stop on the first day. It actually continued for 3 more days. And you can see the volume was around 16 million on the second day of trading. By the 5th day of trading, the volume has been reduced to 612K. As of the time that this video was produced, this low float runner made a run of well over 1,000%, moving from around $1.20 all the way up to $17 within 3 days. A third example of a recent runner is MGT. This stock had several catalysts, including John McAfee relentlessly pumping the stock on Twitter. This stock ran from a low of around 30 cents all the way up to near $5.58 within 8 days. Yahoo currently has the float listed at around 20 million. You can see on day 3 of this big mover, it traded around 30 million. By the 17th, it traded over 109 million for that trading day. Now it's important to remember that not all low float stocks make big moves off a catalyst. It really depends on multiple factors, including what the current trends are. Often when several low float stocks run, you'll see additional low float stocks run. Many traders who have just recently observed some large movers will often be willing to chase up the price on the next one, not wanting to miss out on a big move. It also depends on the type of catalyst, how significant the news is, and how much attention and volume that the catalyst is bringing in. A company that claims to have potentially found a cure for cancer is more apt to bring in more volume than a company that releases a new product line. Other things that can have a large impact is whether the stock is trading in a hot sector or receiving extra attention from large chat rooms or influencers. Just the fact that the stock is up attracts additional day traders. You also want to be aware of if there is any strong negative catalyst affecting the stock. Keep in mind, if you plan to trade a low float stock off these type of catalysts, realize that this is a day trading vehicle and not an investment. The trading strategy behind these type of stocks is not to capture the entire move. You're never going to consistently buy at the bottom and sell at the top. The trick is to capture multiple significant moves on the higher odds trading setups, utilizing the skill sets that you have developed as a day trader with technical analysis, chart pattern recognition, proper risk management, and just like any other trade, enter each trade with a solid trading plan and honor your stops. If you can master the proper trading techniques on a low float stock runner, you may find some of the most rewarding trades of your day trading career. If you found this video helpful and you would like us to continue to make more, please like this video and make sure to subscribe to our page.